Before the screens, before the lines, before the candlesticks turned red and green with every heartbeat of the market, there was only paper, ink, and memory. In the great trading halls of the 19th century, men stood shoulder to shoulder in rooms thick with cigar smoke and desperation. They shouted prices across marble floors. They scribbled figures on scraps of paper that would be worthless by closing time. They held entire markets in their heads. This is the story of how traders traded when there was nothing to see, when the only chart was the one you drew in your mind, when every decision was made in darkness, and every price was a gamble against your own failing memory. The year is 1825. London. The British Empire sprawls across continents. Money flows like rivers through the city of London, that ancient square mile where fortunes are born and destroyed before lunch. And in the coffee houses and counting rooms of this financial heart, men are trading in ways that would be unrecognizable to us now. There are no computers, no telephones, no telegraph wires carrying prices across oceans in seconds. Information moves at the speed of a horse, of a ship, of a man running through cobblestone streets with news clutched in his sweating hand. Trading happens face to face, or not at all. In the coffee houses near the Royal Exchange, merchants gather each morning. They drink bitter coffee from china cups and they talk. This talking is trading. A man mentions he has shares in a South American mining company. Another man nods, interested. They negotiate. They agree on a price. They shake hands. The transaction is complete. No contract, no receipt. Just the word of gentleman and a note scribbled in a leather-bound ledger that might be lost in a fire next week. The prices they agree upon are based on memory and rumor. A trader might remember that these same shares sold for £100 last month. Or was it 90? He heard from a friend that silver shipments were good this quarter. Or were they delayed? Someone's cousin received a letter from Peru that mentioned flooding in the mines. Or was that Chile? Every price is a negotiation between two people's incomplete memories and their competing desperation. Some traders keep notebooks, small personal records of prices they've seen or heard about. They guard these notebooks like holy texts because they are the closest thing to truth in a world of shadows. A man with a good notebook and a better memory can make himself wealthy. A man with neither will be ruined before he understands what happened. The great traders of this era are not analysts. They are not mathematicians. They are storytellers and psychologists. They read faces better than numbers. They listen for hesitation in a voice, for eagerness, for fear. When a man offers to sell too quickly, they know he's desperate. When another haggles too long over pennies, they know he's afraid of losing more. Trading is not about predicting the future. It is about reading the present moment in another man's eyes. By the 1830s, something begins to change. The railroad arrives, and with it, a new kind of speculation that will reshape how trading works forever. Railroad companies need enormous amounts of money to lay track across the British countryside. They issue shares to the public, thousands of shares, tens of thousands. And suddenly, trading is no longer a private conversation between merchants in a coffee house. It is a public frenzy. Men who have never invested in anything buy railroad shares. Clerks, shopkeepers, widows. They buy because their neighbors are buying. They buy because everyone says the railroads will change everything. They buy because the price went up yesterday, so surely it will go up tomorrow. But how do they know what price to pay? There are no charts showing the history of these shares. No graphs revealing patterns. No moving averages or trend lines. They rely on newspapers. Each morning, papers publish lists of closing prices from the day before. Just numbers on a page, no context, no history beyond yesterday. A share that sold for £5 is now listed at £6. That is all you know, that it was 5 and now it is 6. Is 6 expensive? Is it cheap? You have no way to know except your gut. And the half-remembered comment from a man at the pub who said his brother-in-law was making a fortune. The lack of visual information creates a strange psychological effect. Without charts to anchor their perception, traders become completely dependent on the most recent price. If a share closed at £6 yesterday, then £6 becomes the truth, the reference point, the only solid ground in a swamp of uncertainty. When the price rises to 7, traders don't think about whether 7 is reasonable compared to last month or last year. They only know that it was 6 yesterday and 7 today. The momentum is up. The story is good. The fear of missing out becomes overwhelming. This is how bubbles grow in the dark. By 1845, Britain is gripped by railway mania. Everyone is trading railroad shares. New companies appear weekly, promising to connect towns that barely exist. The shares are bought the moment they're offered, sometimes before they're officially offered. Traders gather in new venues. The official stock exchange is too small, too restricted, so they spill into the streets, into hotels, into any room large enough to hold the crowd. These places are called share shops, and they stay open late into the night as men buy and sell paper promises with borrowed money. There is still no way to see the history of a price. No way to know if you're buying at the top or the bottom. The only information is word of mouth and yesterday's newspaper. But confidence is high. The railroad companies publish glowing reports about their prospects. Politicians speak of a new golden age. Everyone who bought last month is richer today. Why would that ever stop? A few observers notice something troubling. They see companies announcing plans to build railroads through mountains that would cost fortunes to blast through. They see share prices that value small railroad companies higher than the Bank of England. They try to warn others, but who listens to pessimists when everyone else is getting rich? Without charts, there is no visual evidence of excess. You cannot point to a graph that shows a vertical line climbing into absurdity. You can only point to numbers that most people don't understand or care to understand. The human mind is not built to process abstract numerical data. We need stories. We need pictures. Without them, we believe what we want to believe. And in 1845, everyone wants to believe in railroads. Then the cracks appear. Small at first. A railroad company announces construction delays. Nothing serious, just a few months behind schedule. But in a market built entirely on confidence and momentum, even small doubts spread like disease. Another company admits its cost estimates were wrong. The track will cost twice what they promised. The share price drops, not by much, just a few shillings. But traders who bought with borrowed money suddenly owe more than their shares are worth. They need to sell quickly, but who will buy? The momentum has stopped. Without rising prices, there is no reason to own railroad shares except the hope that someone else will pay more tomorrow. And when that hope dies, there is nothing left but fear. The panic begins in the autumn of 1846. Prices that took 2 years to climb collapse in 2 weeks. Traders who kept their entire wealth in their heads, who relied on memory and intuition, suddenly find that memory is useless when prices are changing by the hour. Men arrive at the share shops in the morning to discover their holdings are worth half what they were at closing time yesterday. They sell immediately. The price drops further. Others see the selling and panic. They sell too. There is no chart showing support levels, no historical data suggesting where the price might stabilize. There's only the sickening feeling of watching numbers fall into darkness with no bottom in sight. Fortunes built over years evaporate in days. Clerks who borrowed against their salaries to buy shares find themselves owing debts they cannot repay in a lifetime. Families lose their homes. Men lose their minds. The broader economy shudders. Banks that lent money for share purchases face massive defaults. Legitimate railroad companies, ones that might have actually succeeded, cannot raise new capital because the public has been burned too badly. The expansion of Britain's rail network slows for years, all because people traded without seeing, without charts, without any visual representation of what was actually happening to prices over time. In America, the same pattern repeats with different players. The year is 1863. The Civil War rages. But in New York, a different kind of battle unfolds in the gold trading rooms. The Union has suspended the gold standard to finance the war. Paper currency, called greenbacks, is now the law. But gold still trades. And its price against the greenback becomes the most important number in American finance. Traders gather in a basement on William Street. They call it the Gold Room. It is dark, cramped, and loud. Men shout bids and offers across a marble fountain installed in the center to cool the room and dampen the noise. Neither works. The price of gold changes constantly based on war news, government policy, and pure speculation. A Union victory sends gold down. A Confederate success sends it up. Rumors of European intervention move the market in seconds. But how do traders know what the price is doing over time? They don't. Not really. There's a telegraph operator in the corner setting the current price to other cities. There are clerks scribbling numbers on chalkboards that are erased and updated as new trades occur. But there is no continuous record, no line showing the path of the price through the day. Traders make decisions based entirely on momentum and feel. If gold seems to be rising, they buy. If someone they respect starts selling, they sell. The concept of overbought or oversold doesn't exist in any meaningful way because there is no visual reference for what normal looks like. This creates an environment where manipulation is almost effortless. In September of 1869, two speculators named James Fisk and Jay Gould decide to corner the gold market. Their plan is simple and audacious. They will buy enormous quantities of gold, driving the price up. Other traders, seeing the price rise, will buy too. Then Fisk and Gould will sell at the peak and watch everyone else panic. It works because no one can see what's happening. The price of gold rises steadily through September, from $130 to $140, then $150. Traders who watch this rise have no chart showing that this is abnormal. They only know the price is going up, and they want a profit too. Fisk and Gould spread rumors. They hint at government policy changes that would make gold more valuable. They cultivate relationships with officials who might influence the market, and they keep buying, pushing the price higher. By September 24th, gold reaches $160. The upward momentum seems unstoppable. Traders across New York are buying with borrowed money, certain that 170 is next, then 180. Then the government intervenes. The Treasury announces it will sell gold from its reserves to stabilize the market. The news reaches the gold room at noon. The price collapses instantly from 160 to 133 in 15 minutes. Traders scream, some faint, others run for the exits, pushing through bodies to escape a room that has become a tomb. Men who borrowed to buy at 155 now hold gold worth 133. They are ruined. Their brokers are ruined. The banks that finance them are in danger. The panic spreads through the financial system like fire through dry timber. They call it Black Friday, not because of what happened on the charts, because there were no charts, but because of what happened in the minds of men who traded in darkness. The aftermath reveals the fundamental problem of trading without visual information. Investigations show that the price of gold had been manipulated, that the rise was artificial. But most traders never saw it coming because they had no tools to see anything. They were blind men in a room being told which way to walk, and they walked off a cliff together. Across the Atlantic, a Japanese rice trader named Homa Munehisa has been developing something different. It is the 1700s, and in the rice markets of Osaka, Homa is experimenting with visual records of prices. He creates simple markings that show not just the closing price, but the high, the low, the opening, thick lines and thin lines, white and black. He's inventing what will eventually be called candlestick charts, though that name won't appear for centuries. But Homa's innovation stays in Japan. The Western world continues trading blind, and will continue for another century. It's not until the late 1800s that newspapers begin publishing rudimentary charts, simple line graphs showing stock prices over weeks or months. They are crude, hand-drawn, often inaccurate, but for the first time, traders can see history. They can see patterns. They can see that a price which seems high today was even higher last year. This changes everything. Slowly. The psychological impact of visual information cannot be overstated. When you can see a chart, you anchor your decisions to visible history. You can identify a bubble by the parabolic curve climbing to absurdity. You can spot a crash by the vertical drop. You can make decisions based on context rather than just emotion in yesterday's newspaper. But the transition is slow. Many traders resist charts. They insist that real trading is about relationships, about reading people, about knowing information before it becomes public. Charts, they argue, are for amateurs who don't understand how markets really work. They are wrong, of course, but their resistance tells us something important about human nature. We prefer stories to data, we trust our instincts over evidence, and when we've made money one way, we resist changing, even when better tools become available. The early 20th century brings the ticker tape machine. Now prices stream continuously in trading rooms, printed on thin strips of paper that pile up on the floor. Traders watch the tape like mystics reading entrails. They look for patterns in the sequence of trades, the speed of the tape, the size of the prints. But the tape is not a chart. It is still just numbers. Sequential numbers, yes, but without visual context. A trader watching the tape sees that a stock traded at 50, then 51, then 52. But he cannot easily see that this same stock was at 70 just 3 months ago. That information requires memory, or a notebook, or asking someone else. The lack of easy visual reference still creates opportunities for manipulation and panic. The crash of 1929 happens in an era when charts exist but are not universally used or understood. Many ordinary investors who bought stocks in the 1920s, boom, never looked at a chart. They only knew that stocks went up, that everyone was buying, that wealth seemed infinite. When the crash came, it came to people who had no visual framework for understanding what was happening. They only knew the numbers were falling, and they panicked, selling into the void. Today, we swim in visual information. Every trader, professional or amateur, has access to charts showing decades of price history. We can see patterns our ancestors could not imagine. We can identify trends, support levels, historical volatility, and yet we still make the same mistakes. We still buy at tops because everyone else is buying. We still panic at bottoms because the fear becomes unbearable. We still ignore warning signs because we want to believe the story. The tools have changed. The human mind has not. The traders of the 19th century operating without charts were not more foolish than we are. They were simply more honest about the fundamental nature of trading. They knew they were gambling on human psychology, on momentum, on fear and greed. They knew that prices were not rational calculations, but collective hallucinations that could shift in an instant. We pretend our charts give us certainty. We convince ourselves that patterns predict the future, that lines on a screen represent truth, rather than just the visual record of past fear and greed. But deep in the gold room on Black Friday, when the price collapsed and men screamed and fortunes vanished, the traders learned what we keep forgetting, that charts are not magic, that visual information is not wisdom, that the market is, and has always been, a dark room full of people making decisions based on incomplete information and irrational hope. The only thing that's changed is that now we can see our own panic plotted in real time, in full color, updating 60 times per second. Before the charts, traders knew they were blind. They accepted it. They made their peace with uncertainty. Now we pretend we can see, and that pretense might be the most dangerous illusion of all. The smoke-filled trading rooms are gone. The marble fountains and the shouting men have been replaced by silent screens and algorithmic trades. But the essential truth remains unchanged. Every price is still a negotiation between hope and fear. Every trade is still a bet on what other people will believe tomorrow. And every trader, whether in 1825 or today, is still walking through darkness, trying to convince themselves they know where the light is. The only difference is that now we have charts to illuminate our path to the same old mistakes. And in that room in your mind, where you make your trading decisions, it is still 1825. You are still in the coffee house, listening to rumors, watching faces, trying to decide what something is worth based on incomplete information and the last price you remember. The charts have not saved us from ourselves. They have only given us more sophisticated ways to avoid seeing what has always been true. The trading has never been about knowing. It has only ever been about believing, and hoping you're not the last believer when the belief dies.